So welcome to the Deal Finders Corner, your weekly property talk show brought to you by Property Filter, hosted by myself, Guillaume Black, your favorite Frenchman. I'm the CEO and co-founder at Property Filter. It's the UK's highest rated platform to find deals, and we're on a mission to empower our property investors and deal sourcer members to find 1,000 deals in the next 12 months, thanks to the Property Filter blueprint. And the purpose really with these Deal Finder Corners is to give you more and the best of the available resources by inviting expert guests who will share with you the latest and most current strategies, tactics, and secrets about what actually works right now in terms of finding and making deals and the reality of systemizing and running a high-performance business in property. So it is my pleasure today to introduce you Penelope Walters on today's Deal Finder Corner. So Penelope is a chartered accountant with over 20 years experience and specializes in property. She's also the director and principal accountant at Trimantic, where they offer specialized cost-effective accounting solutions tailored for investors like us and like you guys today. And so whether if you are a small business, contractors, or freelancers, you can work under limited company umbrella or work under your own tax regime. So what we will cover today, so with Penelope, we'll be going back on the impact of Section 24 and what it means for you as a landlord, or what it means for the landlords you are working with. So for that, we will explain the criteria for tax advantages that surround service accommodation for an investor like yourself, as well as for investors, so as landlords you are working with. And again, this is so that you can save landlord tax if you want to take on their property on a sort of management arrangement. And then we'll have plenty of times to go through some Q&A. So I'm very much looking forward to the talk and hearing more about Penelope's talk today. So please give a massive Property Filter virtual welcome to Mrs. Penelope Walters. Thank you very much.
So, as Guillaume said, I'm a chartered accountant of over 20 years experience. I worked my way up through the accounting ranks in the City of London and ended up being a finance director for a PLC before deciding to leave the city to move out to Hertfordshire and set up my own accountancy practice. I'm what I would describe as an accidental landlord. I have a small portfolio of properties, but I never actually intended to become a property investor. I owned a property when I met my husband, who also owned a property. We decided to keep them and rent them out when we bought our main home, and then we bought a holiday home, and then we inherited a property. So we've ended up with a small portfolio that we never planned to. So one of my goals, of course, as an accountant, is to try and find the most tax efficient way of leveraging those properties. Particularly, over the last sort of 2 decades, we've seen a whole host of new tax laws brought in that negatively affect landlords. It seems to be whichever government we have, there seems to be a sort of an anti-landlord sort of flavour to all the legislation, which of course makes it more and more difficult. So as a property tax enthusiast, I would say, we're always trying to find ways to help landlords to leverage their investments. I always say to people that it's really important to have a property accounting specialist for exactly the same reason as you wouldn't go to see, your GP for tooth pain. Tax law is incredibly vast and incredibly specialist, and it's impossible to understand everything about everything. So you really have to specialize so that you understand that particular area of the legislation really well and can help people. I always say to people as well, it doesn't matter if you have an accountant for your trading business or your existing activities. You can work together. They can be part of your team. It's about bringing expertise together to help you to leverage your investments and to help you achieve your goals. It shouldn't be one accountant for everything. They can very much work together. So I'm going to be talking to you today specifically about serviced accommodation and furnished holiday letting. Serviced accommodation is the term which is obviously very trendy right now. A lot of people have heard of that. Few less people about furnished holiday lettings, and I'll explain to you what the relevance of that is. We'll also be running through what exactly qualifies as tax advantage serviced accommodation, what those tax advantages is, and of course some downsides. So I'm going to start with, sort of property investing 101. What exactly is profit? Well, Anybody with any kind of business acumen at all will go, well, obviously, you know, income minus expenses gives you profit. However, HMRC don't always agree with this view. So we need to be very much aware of something called taxable profit, because this is the profit which, when calculated, is what you will pay tax on. But you as property investors, or indeed as any business people, you're more concerned with retained profit. So this is the income that you're left with after you've paid all your expenses and all of your taxes. So as an illustrative example, so this is how, if I was a property investor, I would be calculating profit. I'd be looking at my rental income, I'd be taking off my direct costs, I'd be taking off my mortgage interest, and that's what I would consider to be my profit. And that's how it used to be until the 2015 Finance Act, when something called Section 24 came in, which had a significant impact on the way that higher rate taxpayers were taxed on their rental income. So, little example now. So, if you're a lower rate taxpayer, then Section 24 does not apply to you. You can own a property in your own name as a lower rate taxpayer. You will pay a lower rate tax on your actual profit. So in the previous example, the £3,000 that we calculated as being your rental profit. Again, you can see in my example here, your rental income minus your direct costs, and then your mortgage interest gives you your £3,000 of profit. And then and then you will pay tax at 20% on that, which is just £600. However, how you arrive at that figure is slightly more convoluted. See, HMRC will consider the taxable rental profits to be the rental income minus the direct costs. So in this example, the income minus direct cost is 28,000, and then they apply your tax rate to that. So you apply 20% tax rate to that, and then you get mortgage interest relief on the mortgage interest that you've paid, and that's at 20% as well. So again, if you're a lower rate taxpayer, you're getting 20% tax relief on your mortgage payments, and then you're paying 20% tax on your taxable rental profits. Convoluted way to arrive at simply 20% of your actual rental profits. Now, the reason why I went through that whole process is to explain the impact on a higher rate taxpayer. So if you're a higher rate taxpayer, then the 40% tax rate is applied to your taxable rental profits. So in this example, the 28,000. And then you still only get lower rate tax relief on your mortgage interest payments. So in this example here, you can see this person's actual profit is £3,000. But they'll end up paying tax payable of £6,200. That's because HMRC will apply a 40% tax rate to your taxable rental profit, but only give you tax relief at the lower rate. So you can see in this example here, now this is an actual genuine person that I'm using as example here. This person here is actually losing £3,200 every year by renting out this property. Now, this is a situation that's faced by a lot of property investors who own properties in their own name. I stress in their own name because it's slightly different when you're owning property in a limited company, and particularly in recent years, as we're starting to see interest rates creeping up and up, those rental losses are only going to increase. So, if you were operating through a limited company, I just thought I'd run through here just to quickly explain the difference. So if you bought a property in a limited company, then you would be calculating tax on the actual profit. So again, income minus direct costs minus your mortgage interest gives you your actual profits, and it's calculated in that way when you operate through a limited company. You'll pay 19% corporation tax. It does go up if your rental profits are over 50,000. But let's just assume that this example here only has the one property with rental income of 30,000. So you'll pay 19%, the company will pay 19% corporation tax on these rental profits. Then, as the investor, if you then wish to withdraw those profits, you'll then have to take those out of dividends. And as a higher rate taxpayer, you'll pay 33.75% tax on those dividends. But still, if you hold the property through a limited company, you'll still end up with some residual retained profits, unlike if you're a higher rate taxpayer holding a property in your own name. So what can you do if you're a high rate taxpayer? You have some options, of course. Well, the first one is you can sell, slightly nuclear option. This is what a lot of people are doing at the moment. You know, this is why we are seeing a lot of buy-to-let landlords leaving the market. You know, there are costs though associated with selling. You know, you might have some capital gains tax to pay if you've held the property during the period when it's gone up in value. It's not a brilliant time to sell at the moment, because there's a slightly depressed property market. As I say, lots of people looking to sell. And of course, there are going to be disposal costs associated with selling your property. You could incorporate the property. This is what a lot of people did when this legislation was initially introduced. But of course, there will be costs associated with that as well. Just to run through the obvious ones, you know, the stamp duty. You've got to bear in mind that when you transfer a property from your own name to a limited company is a separate legal entity. It's a person in its own right. I always describe it as being kind of like a child in that you own it and you control it. However, it is a person in its own right. So when you transfer that property to your limited company, it's a disposal. You're selling that property. And when you're selling that property, then it's going to incur stamp duty. There are some exemptions for that. I'm not going to go into them because that's outside the scope of what we're talking about today. But stamp duty is a big cost that most people need to be aware of. There might be some capital gains tax. Again, when you're transferring it over to the limited company, then you're going to have to pay capital gains tax. Again, if you've lived in the property, there's a possibility of private residence relief. It's going to be a separate legal person who's going to own the property. So you're probably going to have to refinance your mortgage. You know, there might be early redemption fees. There might be refinancing costs associated with that. And then, of course, you're going to have some legal fees to actually get that done for you. Just bringing back to the stamp duty as well, just to mention, in case anyone's not aware, limited companies always pay the surcharge. So even if a limited company is brand new, has never owned a property before, unlike an individual, the surcharge only applies to second or third properties. With a limited company, stamp duty, the surcharge applies to the very first property. So just bear that in mind. Okay, so when you're looking at your options, I highly recommend that you do a calculation, something like this. This is what we do with our clients who come to us who are considering what to do with their property if they're higher rate taxpayers. I always think it's very important for you to look at the big picture. You know, it became sort of, you know, quite popular to just, you know, for everyone to just give standard advice that, oh yes, you know, move to limited company, avoid section 24. But it very much depends on what your goals are, what your plans are, what your time frame is. You know, if you're going to be saving, you know, £3,200 a year, but it's going to cost you £15,000-20,000 in initial costs to actually transfer the property to a limited company. You know, if you're only planning on doing this for a few years, then it's really, you know, it's possibly not going to be worth doing. So you really need to have a think about what your long-term goals are. Have a look at what it's going to cost you initially, and also what it's going to cost you on an annual basis, and just decide, you know, at that point whether it's actually worth transferring to limited company. This is the kind of calculation which, you know, you can do yourself, or, you know, if you've got an accountant, then you should be encouraging you to do something like this before jumping into what was, you know, sort of the popular option. The third option, and the one that we're going to talk about today, is serviced accommodation. Specifically furnished holiday lettings. So what is it? It's serviced accommodation is a really trendy term right now. However, it's not actually one that's defined in law. It's an all-encompassing term that simply means that the landlord is providing services to guests staying in that accommodation. So it could be any kind of residential accommodation with services attached. They could be long-term, they could be short-term. It could be, you know, one of these new blocks which has got, you know, a gym on the roof and concierge service, or it could literally be, you know, a guest house in Devon offering a bed and breakfast, and, you know, that sort of thing. So why is it relevant? Well, the most relevant thing with service accommodation is how it's let out. So not simply what those services are, but how it's let out, because the how determines the tax treatment. So a long-term basis, a long-term basis, you know, even if you're providing services, is taxed in exactly the same way as any other long-term residential rental. You'll be taxed in exactly the same way as we went through in some of those previous slides. To get the tax advantages, it needs to meet the criteria to be a furnished holiday letting, because a furnished holiday letting isn't considered to be investment income like normal residential lettings. It's considered to be a trading income like a hotel. So the benefits of furnished holiday lettings in a nutshell is that tax is obviously paid on income after deducting costs. So the more costs that you can deduct when calculating your taxable profit, I've bolded that, you know, to make the point that it's not your actual profit, but your taxable profit, the lower amount of tax you pay, and therefore the higher the amount of retained profits that you get to keep. So it's not just about the cost that you incur, it's the costs that are eligible for deduction. That's very important. You know, I get asked a lot, you know, should I go and spend this because then I'll get tax relief? And it's like, well, you should only incur a cost if you think it's beneficial to the business. You shouldn't do it simply to get the tax relief, because even at the highest rate of tax, you're still going to be paying more out of your pocket than HMRC are out of giving you extra tax relief on that. So the thing which we're trying to achieve here is to not increase our costs, but increase the cost that you're allowed to deduct when calculating your taxable profit. And that can be achieved with furnished holiday accommodation. So some of the advantages in a bit more detail. So first of all, and the most significant one for most people, is that mortgage interest is fully deductible. So you can, in the example that we gave earlier, you can deduct your mortgage interest when working out your taxable profit. Capital allowances can be claimed for furnishing the property. That's another very significant one. So for residential lettings, you cannot deduct the cost of furnishing the property. You can deduct the cost of replacing furniture, but you cannot deduct the cost of initially setting up that property for rental, but you can if it's a furnished holiday letting. So that's very significant. There's even some benefits is if you've purchased a property, some of the fixtures and fittings can be claimed on the initial purchase. That's a bit more of a specific one. You know, we need to involve a surveyor and whatnot, but it is something worth bearing in mind. Business asset disposal relief is available. This is another significant one. So if you're making a gain on a furnished holiday lettings, when you sell it, rather than having to pay capital gains tax immediately, there is the option to defer paying tax on that gain. And I'll explain a little bit more about that later. Because it's a trade, so furnished holiday lettings are a trade, they are relevant earnings for calculating pensions contributions. So there is a cap of the amount of tax relief that you get when you're paying into a pension scheme, which is your relevant earnings of £40,000 per year. So because residential property lettings are considered to be investment income, they're not relevant earnings. So if you're trying to put some money into a pension scheme and you're investing primarily in property, then that's something that may benefit you as well. The company will be paying a business rates, or the business will be paying business rates on those properties instead of council tax. Now, if you only have the one premises, then it might be eligible for small business rates relief, which means you might not have to pay any business rates at all. So these are all small benefits that, when add up to the whole, can give you some significant savings. So, having established the fact that a furnished holiday letting is a good way to let out your property, we have to look at what the criteria is. So the most obvious one is it has to be furnished. So it has to be furnished to a standard that somebody could stay in it on a short-term basis. So, and the furniture has to be available for the use of the person staying there. It has to be located in the UK or the EEA. It can't, unfortunately, in the wider world, they don't qualify as furnished holiday lettings, and so it has to be in these areas. And they have to be let on a commercial basis, which means there needs to be an intention to make profit. there's the concept of intention is very significant in the UK tax system. You can be intending to make a profit and fail miserably. There are lots of failing businesses out there who are intending to make profit, but you have to have an intention. Therefore, you can't set up a property, rent it to friends and family on below market rates, and then try and claim a tax relief for it. There has to be done on a commercial basis. There has to be your primary intention to make profit. It has to meet availability conditions. So it has to be available to let for at least 210 days per year. If you're staying in the property, it's not available to let. People try and argue this point and they say, oh, but if I got a phone call, I could pack the kids up and leave the following morning. But HMRC don't see it that way. If you're in it, if it's being occupied by the owner, then it's not available. So bear that in mind. It has to be available for at least 210 days to be let to the public. If you're letting it on a longer term basis, which you are permitted to do as long as it doesn't prevent you from meeting your ratios, then that wouldn't count either. It has to be available to the public as a furnished holiday letting. And it has to meet certain minimum occupancy conditions, which means that it actually has to be let out as a furnished holiday letting to the public for at least 105 days per year. Again, it has to be done commercially. So, lets to family and friends at discounted rates don't count. Lets when you're there don't count. Lettings of more than 31 days equally don't count. That's not to say that you can't let it out, down season, not a lot of people using your cottage by the sea in February, so you can let it out on a slightly longer term basis or at non-commercial rate for a short period of time, as long as it still meets its 210 day availability and as long as it's actually let for 105 days. So if you are letting it out on more than 31 days at a time, the total of all those lettings can't be more than 155 days. Otherwise, you cannot meet the criteria. So what happens then if you don't meet the criteria? Well, the first thing that you can do is you can use the averaging election. So if you have more than one furnished holiday letting, then you can add the data from both of those properties together and then take your averages and see if they meet the criteria then. So for example, if you have one property that does incredibly well and it's let out for 48 out of 52 weeks a year, you have another property that you try equally hard to rent out, but it doesn't seem to do anywhere near as well. You can add them together, divide by 2, and if on an average they meet the criteria, both properties, or if there's more, all the properties meet that criteria. HMRC also give you a period of grace election. So again, if you genuinely intend, that concept of intention again, to meet the criteria, but you fail, then for up to 2 years, you can have a period of grace, which means that you're still treated as operating a furnished holiday letting, even though you didn't meet those criteria. COVID was a great example of people needing to use this, because obviously, you can't have actually people staying in your property if we're all locked in our houses. So you can use one, you can use both of these elections to help you to meet the criteria if you're struggling despite your best efforts to operate a furnished holiday letting and meet the criteria. So having established that we've got a furnished holiday letting, how do we calculate our taxable income? Well, I thought I'd run through some of the other options as well as the traditional working out our taxable profits. So the first one is, and this can apply to any property income, residential or furnished holiday lettings. If your expenses are very low, you don't have a mortgage, then you can simply claim the property income allowance. Everybody's allowed to receive £1,000 completely tax-free per year from renting out property. If you rent out property that's jointly owned, you each get £1,000 per year. So if you've got a little property, it's giving you, £6,000 a year gross income. You don't pay very much out in costs. It's owned jointly with a partner. You can claim £1,000 tax-free, as can your partner, and then you just pay tax on the rest. So that's the simplest, easiest option. If you're renting out part of your own home, and again, this is becoming increasingly popular, where we're seeing people renting out, you know, sort of their granny flat or a few of their spare bedrooms on Airbnb, then if you're renting out part of your own home, now this only applies to the home that you live in, your home, and your gross income is less than 7,500, you can simply claim the rental room allowance, so that you can earn up to £7,500 gross, so before deduction of expenses, per year from renting out rooms in your own home. You don't even have to declare it, you're just allowed to receive that. If the property is owned with someone else, then that allowance is halved. So unlike the property income allowance where it's per person, the rent of room allowance is for the property. So you would each be allowed to receive 3,750 each. So the third option is we calculate our taxable profits. So this is where we go back to our original example that we did. We deduct our expenses, we deduct our mortgage interest, and we deduct our capital allowances from income when working out the tax that we have to pay. So I thought I'd run through some of the allowable expenses for furnished holiday lettings, because a lot of people ask me about this. So first of all, I'm going to highlight the concept of wholly and exclusively for the purposes of trade. Again, a lot of people, can I put this through? Can I put this through? The answer is, if you incurred that cost wholly and exclusively with no duality of purpose for the purposes of your furnished holiday letting business, then the answer is most likely. If you incurred it for some other purpose, or there is some sort of split purpose, part personal, part business, then the answer is probably not. So I've highlighted in here the items which you wouldn't be able to reclaim if you are operating residential lettings. So mortgage interest relief is the main one for furnished holiday lettings that you can't claim if you're operating a normal residential letting. General maintenance and repairs to the property, not capital improvements. This is something that all residential or furnished holiday letting landlords can claim. So repairs and maintenance. I stress not capital improvements, because sometimes it's quite difficult to actually make that distinction between what's a repair and what's an improvement. HMRC do acknowledge the idea that, you know, things have become better over time. They talk about things being a like-for-like modern equivalent. So if you go and you buy, a washing machine or a sofa bed now compared to, you know, in the 1980s, it's going to be better. But if you went for a, budget or a mid-range one back then, and you're going for a budget or mid-range one right now, then that would be considered a like-for-like equivalent. If, however, you decide that you want to reposition your property business to be slightly more high-end, you know, you want to get slightly better quality of clientele, and so you decide to replace your existing your existing items with a modern equivalent which is better, then that would be considered to be an improvement. So you would only be able to get tax relief up to the value of the like-for-like improvement. The other very significant one for furnished holiday lettings, which you can't get for residential lettings, is the initial purchase of furniture and white goods. So initial purchase for residential is not allowed. So, however, you know, obviously replacements would be, but for your furnished holiday letting, once you've rented a property or you own a property, all the initial setup costs of getting it ready for your furnished holiday lettings are allowable deductions as capital allowances. Then we've got all the general running costs, so your utilities, your council tax or business rates, gas, electricity, insurances, gardeners, cleaners, agents, all of the people that help you run that property. Rents if you're subletting, ground rent, service charges, everything to do with running that property, advertising, marketing, obtaining your certificates, doing your reference checking, things like this, but also general costs of running a business. Again, this is a trade. You are running a business here. So other things like, your travel and accommodation costs, if you're having to, drive down to the property to check people in, to see, to let the gas man in, to do your gas safety certificates, if you're having to attend conferences, and how to market your property better, if you're meeting with other investors to help you develop your business, all of these, travel, accommodation costs would be allowable costs of that business, because the purposes for incurring those costs are for the purpose of the trade of the business. There'll be some other overheads which you can put through as well, things like mobile phone, some of your home office costs, and general sort of travel. Again, there has to be for the purposes of trade. I do appreciate that, obviously you run your home anyway, and so there's going to be a duality of purpose then. And what we do is we help people to work out, based on the amount of their home that they use and the amount of time that they use that space for, to work out how much of that is attributable to running the business, and that's how much you would be able to claim as a deduction. So business asset rollover relief, just to give a quick overview for people to understand what exactly this is. So with capital gains tax, when you sell a property, then you have to pay tax on the difference between what you paid for it plus all the costs, what you sold minus all the costs, and any improvement costs, basically the things that you wouldn't have been allowed to deduct as some of your running costs when doing your normal self-assessment return. So that then gives you your capital gain. There'll be an annual exempt amount. It's been sadly going down over the last few years, from 12,300, 6,000 this year, going down again next year. Top tip, if you are planning to sell something, better do it before the April tax start next year, to be able to take advantage of that greater amount of the tax-free amount for capital gains. With business asset rollover relief, because this is considered to be a trading asset, instead of having to pay capital gains tax immediately, if you reinvest in another trading asset, so whether that's another furnished holiday letting building, or whether it's another trading asset, for example, if you decide to reinvest in some other asset, if you're setting up a construction company, a digger, or you want to something else that is required for your business, then you can roll over your gain into that new purchase, which means that you don't have to pay capital gains tax immediately. You would pay capital gains tax when that new asset is sold. There's quite generous allowances around business asset rollover relief. You only need to be planning to reinvest to be able to defer your gain. If you don't reinvest the full amount, then you can get partial relief for the amounts that you do reinvest. And as long as you buy your assets within 3 years of selling and then purchasing the new one, then you will qualify for that. So business asset rollover relief is quite a useful one if you're thinking about maybe buying and selling your furnished holiday letting businesses. So a few downsides then of operating a furnished holiday letting. Well, and this is where I say to people is that you can't just look at the tax side of things. You've also got to look at your lifestyle, your commitments, what you're actually willing to do. Because operating a furnished holiday letting business or serviced accommodation, it's a lot more labour intensive. When you're operating a residential letting, unless you have a very demanding tenant, generally speaking, you sign your AST and you leave them to it. With a serviced accommodation business, you're going to be constantly checking people in. You're constantly having to be dealing with people. It's much more labour intensive. You could, of course, appoint an agent, and there are lots of good agents out there. However, they of course need remunerating for the work they do, and so that's going to affect your profit margin. And as our goal here is obviously to leave you with the maximum amount of post-tax retained profits, then that's a consideration. Another thing that you very much need to think about is, it's a variable income. That there are likely to be periods of vacancy, particularly if you've got a property that's in an area which is a high degree of seasonality. That's something very much to think about. If you're used to receiving a certain amount of rent on a certain day of the month and you need that to support your personal cash flow, then a variable income might have an impact on you. So, that's something that you'd need to consider as well before going down the furnished holiday letting route. There's obviously going to be, the cost of services. Again, unlike residential property letting, where most of the costs will be borne by your tenant, you're going to have to pay, your gas, electricity bills, regardless of whether you've got somebody in there or not. You also might have the cost of initially furnishing the property. The old sofa that you got from Granny's house years ago might be fine for when you're staying down in Cornwall with the kids for the week. But if you're going to be renting this out, you might need to invest in furnishing the property to a standard that people are actually willing to accept. There might be restrictions in your lease and mortgage conditions as well. This is something that very much needs to be checked. If you have, if you have a mortgage, you need to check with that. The last thing you want is to be in default and find that out the hard way. Depending on local authority, you might need to get planning permission. I know Airbnb, it's quite famously they've got certain restrictions in the Greater London area, so you need to have a think about that before jumping straight into this. If there are anything that's going to prevent you from doing this or could cause problems in the future. And VAT registration. This could be an issue if ironically, if you're very successful in your furnished holiday letting business. If your income, this is your gross income, this is not your profit, this is your gross income, this is the amount that you're receiving from your tenants before deducting your Airbnb fees, before deducting your cleaners and all this sort of thing. It's the amount that you're actually receiving from your guests. If that exceeds 85,000 in any rolling 12-month period, it's not calendar year, not tax year, it's rolling 12-month periods. You have to look at the last 12 months at any point in time. And if that's gone over 85,000, you are legally obliged to register. So you could consider who your clients are. So if you are required to register for VAT, if you deal primarily with corporate clients, people, renting your property so that they can house contractors coming down for meetings, that sort of thing, VAT registration might not be an issue. However, for individuals, it is. Very few of us look at a price and go, oh, yeah, it's £10 plus VAT. No, the price is £12. So, if you're running your business properly, you're unlikely to be able to suddenly put your prices up by 20%, because one would think that you're charging the maximum that you can for that property anyway. There are some things that you can do to lessen the impact on this. So, you could register for the flat rate scheme, particularly if a lot of your expenses don't have VAT that you could reclaim. A lot of cleaners are not VAT registered, that sort of thing. So that is one way of lessening the impact of that registration. Contrast that to residential accommodation, which is VAT exempt. You don't charge VAT on that. There are some other little sort of nuances with the mandatory VAT registration. If you do a continuous let of more than 28 days, remember I mentioned before, is that lets of more than 31 days don't count. So lets between 28 and 31 days, the VAT is only charged on the days 1 to 28. Under VAT rules, a long-term let is considered to be more than 28 days, slightly different to under the furnished holiday letting rules. So if you were going to rent out your property for a slightly longer term basis, I mentioned before, maybe some downtime, if it was not going to affect your criteria, then that's one thing that you could use. So one of the other things to mention is the exemption does not apply to block bookings by companies. So some people say, well, I let it to a company for 3 months. Does that mean that it doesn't count? Well, it depends on who's staying there. So if you've got somebody, if your company's letting it, but then again, you've got people, a revolving door of contractors or nurses or people coming in, then it's the people who are staying there rather than who's made the booking. And one other thing which is quite topical is the tour operators margin scheme, the TOM scheme. We got very excited about this during the summer because a taxpayer won at the first tier tribunal against HMRC. They were using the TOM scheme to pay VAT not on the gross amount that they were receiving from their guests, but instead they operated a rent-to-rent model, and they were paying just VAT on the difference between what they were renting the property for and what they were charging guests. So obviously, if you're renting the property at £100 a night and you're charging it out at £120 a night, they were only having to pay VAT on that £20 rather than the £120. Now, this was significant. So as you can imagine, having announced that the taxpayer won, we all got very excited. Very short amount of time later, HMRC, I've put could here, clearly my slides are a few weeks out of date. HMRC have already appealed it. So that will go to second tier tribunal. We probably won't find out if this is going to become a permanent thing or not until next year. But for the time being, if you operate a rent to rent model and your income's more than 85,000 per year, meaning that you've been forced to register, then you should definitely talk to your accountant about using the TOMS scheme to account for your VAT whilst HMRC put their case together to take to second tier tribunal. So that was it. That's me. Here are my details. If anybody wants to get in touch, it's Christmas. Then we're offering a free 20-minute consultation to anybody who just wants to have a chat, has a few questions, just wants to know if they're going in the right direction. Best way to contact me is via WhatsApp. My number's there, and then we can book you in for your consultation.
Awesome. Thanks so much, Penelope. I learned quite a few new things. You know, when you talk about the fixtures and fittings that will rely a surveyor to come and we could get some capital allowance, what would it be, for example? What would we be able to claim?
So capital allowances is basically you are able to under the annual investment allowance, you're able to claim the full cost in the period of purchase. So if you bought a new washing machine, a new sofa, a new bed, new wardrobe, dining room table, all of these things would be eligible as capital allowances in the year of purchase. If you're operating furnished holiday letting business.
Yeah, so that's the furnishing, and then you had the second line about fixtures and fittings. So what examples of fixture and fittings would it?
Right, so this is a slightly more complicated one. I'm not going to go into too much detail about this because it's very specific. So if you're buying a furnished holiday letting, say you're buying a holiday cottage in Cornwall, when you're making that initial purchase, you're going to be negotiating an overall price with the seller. If done correctly, and this is not something that you can do it yourself, this is something that you'd really need to take expert advice. You need to get a surveyor in. There's a way that you can split out the purchase price between this is for the property itself and this is for the fixtures and fittings contained within that property. Yeah. And by doing that, there is a possibility to actually be able to claim capital allowances on those elements that you've purchased, because obviously if you've bought a property, you can't get tax relief against your rental income for the amount that you've paid for the property. However, if you've, as part of the property purchase, you've bought a washing machine, a wardrobe, things like this, you may be able to claim tax relief for the washing machine, wardrobe and other parts that came with the property.
Okay, awesome, thank you. And later you talked about the average election. And is it if one property overperforms, or is it a must that all the average of the portfolio must be within the qualification criteria? Yeah, is it if one doesn't, we can call this, or is it a must that the whole portfolio on average must comply?
For each property to be treated as a furnished holiday letting. Now, bear in mind that you can choose to operate it as a furnished holiday letting or just report as residential letting. Mm-hmm. To be honest, very few people would elect to or would choose to want to report as just a residential because you get less tax relief by doing it that way. So if you want these properties to be treated as furnished holiday lettings, either individually they can meet the criteria, or when added together and an average taken, they can meet a criteria. So basically it helps you if you have a successful property and a less successful property. The successful property can bring up the less successful property so that it meets the criteria when it wouldn't by itself.
Okay, but it's not a must. I mean, that the whole portfolio must on average, because you could say, oh, this one, you can bring it if you want, but you don't have to if you like.
Yeah, correct. If you might decide this one's been a disaster, in the end, I let my aunt use it for the year. We just gave up trying to treat it as a furnished holiday letting. We'll just ignore that one. That's just reported as a normal residential letting, and then the rest of them will meet the criteria.
Okay, awesome. Thanks so much. So we've got two questions on rent. One is on the TOMS, so the tour operator margin scheme. So it's something to watch as the appeals go through, but there's already good signs that this would work well. So as a rent-to-rent operator, so would I then structure, and especially if I want to scale it and make it quite successful, would I then want to structure so that my reported income is this margin rather than the overall rent? So how can I do that?
Yeah, exactly. In fact, I have, if you don't permit me to share my screen one more time, my window, I just want to make my thing come back. Hold on. This one? Are we back on my screen?
Yeah.
Okay, so you mentioned this to me earlier, so I did a little bit of digging on this. So I've been asked before, so if you have somebody who's trying to convince a rent-to-rent landlord to give them a property, could they then tell that rent-to-rent landlord that they themselves, the landlord that is, not the person from whom they're renting, to whom they're renting, could they would they qualify as a furnished holiday letting status? So that comes down to the technical aspects of the arrangement between yourself and the rent-to-rent landlord, because there's basically two ways to rent to structure the agreement. I'm not a lawyer, so please do your own research on this, but my understanding is that you can either go down the commercial lease agreement route, or you can go down a management agreement route. So a lease agreement is where you're taking on the lease for that property, and then there's a clause in there which allows you to then sublet it. And then the alternative is a management agreement where I'm managing the property for you. Now, I found quite a useful post on the HMRC community. This is like a bulletin board where you can go in and you can actually post questions and sometimes get answers directly from the HMRC staff. So this is quite a good resource for people. There's a little link to this specific particular one there, but that's quite a useful one as well, because you get people asking kind of sort of the kind of specific questions that you may yourself want to ask. So what they've said here, so the person said that they're using, oh, it's gone.
Go back one.
There we go. So they said that they're going to be using a management company that will guarantee them a certain level of rent each month, i.e. rent to rent. As they're asking, do they have to rent directly to the public themselves and get the money from the public, and then pay the agency a commission, or will that guaranteed rent, i.e. the rent to rent, will that guaranteed rent, because the property is being used as a serviced accommodation, furnished holiday letting, will they still be eligible? Now, the HMRC answer, I've trimmed it down to the relevant bit, says that provided the property meets the criteria, and then it can be treated as a furnished holiday lettings, even if the rents are initially paid to the management company. So that, I think that's one of those things where the devil's in the detail. If you have a management agreement, so you're renting from a landlord, sorry, you're managing the property for a landlord, you're receiving the rent from the guests, and then paying it to the landlord in a slightly different way from the pattern that you're receiving it. You're receiving it on a nightly basis, you're paying it to them on a monthly basis. Then HMRC have indicated that they would be happy for the rent-to-rent landlord to treat that as a furnished holiday letting. That is likely to be different if you have a straight lease agreement which says, I am leasing the property from you on a commercial basis, and then running it as I see fit. So my advice to anybody who is looking to convince a rent-to-rent landlord to give them their property that they could then use to operate as a furnished holiday letting, you know, for them to meet that tax relief, you need to get the right kind of agreement in place.
Which is on the management agreement side. Yeah.
Exactly, which would be management agreement, because what you're doing is you are managing that furnished holiday letting, and effectively your commission is the difference between what you're making from guests and what you're paying as a guaranteed rent to your rent-to-rent landlord each month.
Awesome. Yeah, that's really interesting. Thanks so much. I'll move into the chats and the questions there. So Raj is asking, how much starting capital will I need to start a SA business if I'm a beginner? So this is not quite the scope of today. So I recommend look into episode 8 of these Deal Finder Corners. And there's something with Mark Fitzgerald and Graham Lindley. So if you go inside Property Filter, you'll see them. And they went through this, and they'll reach out to them and they'll help you set up if you're starting out. Ed is asking, we run a successful holiday-let business in a self-contained annex on the side of my house. We have one residential mortgage covering both the main house and the annex. Can we split the mortgage interest proportionally and claim part of it as expenses for the holiday-let? It's quite an interesting question.
So yes, you can. You have to do it on a fair and just basis, I think is the words that HMRC use. So yes, so you can apportion it. You can apportion it. So the first thing I would ask, I would suggest doing is looking at what your gross income is going to be. If it's $7,500 per year or less, just claim the rent a room allowance. Job done, nice and easy. If it's a lot more than that, then yes, you can apportion the rent. You can apportion the mortgage interest rather.
And on this, Penelope, so it's really interesting. So this is one or the other. It's either you claim the $7,500 grand, or you claim all the bits you listed.
Exactly. So if your gross income, so the amount before any deduction is 7,500 or less, just claim that, and you don't have to keep record of any of your expenses or anything like that. It's only if your income is more than that and you want to claim your expenses, it's either the rent-a-room allowance, or it's you report deducting expenses.
Awesome. And as a side note for you to know, so it's quite close to my heart, these things, because the way we funded Property Filter to start with is I had lodgers in my house paying the developers directly some few years ago. So yeah, I'm quite well aware of how this works. So yeah, it reminds me of some stuff in the past. Ed is asking, is VAT registration per property or for the business? We have 2 Airbnb's units owned by my wife and I.
Yeah, so it's for the business.
Okay.
So if you're operating them as separate businesses, so for example, if your wife owned a property and reported her income on her tax return, and you owned a property and you reported that on your tax return, that you could argue that they're separate businesses. If you jointly own both properties and you're operating them as serviced accommodation businesses, then that is one business. It's not per property, it's per business.
Okay, that's really interesting. Right, asking, does what we've talked about apply to rent-to-rent model? And I think we covered it at the end. And now, can we claim rent-to-rent operator? Can we claim the rent-to-rent operator reliefs, or can the landlord? I think we covered that already. But in the main, it's very interesting if you could go and sell to a landlord the idea that you're going to get guaranteed rent. We've heard it a lot in the last 5 years. Or you could go and solve their tax problem to say, hey, we'll move into a management agreement whereby you don't have to sell your property, which is the initial scenario Penelope presented, where a lot of landlords are stuck with. You can keep your property, and I can help you offset and release all of this extra tax that came to you on the Section 24. I think it's a lot better offer and a lot more appealing to a lot of landlords, so that will work like this. And then from your operation, so you can follow this tour operator margin scheme pending the appeal, but I think until it's resolved, that's probably something I would look into. Want to speak with Penelope, because I'm not the expert. Adam is asking, can capital allowance claim on purchase for capital allowance claims on purchase, does that include fixture and fittings like electric, plumbing, kitchen, bathroom? I think there are some limits to it.
Yeah, there will be limits, and as I say, we're getting into quite specific detail. So that's the kind of thing. As I say, you'd need to have a surveyor that works out the valuation for this sort of thing. It's the kind of thing that the more sizable the deal, the more worthwhile doing something like that would be. If you're buying a property with the intention of making it habitable, making it nice, sort of refurbing it, then it's less likely to be as beneficial. But yeah, it's definitely something to have up your sleeve, because if you are buying a property that already meets the criteria as a furnished holiday letting, and you're going to be operating it as a furnished holiday letting, then potentially a lot of the fixtures and fittings could be treated as capital allowance.
But really, it's more bigger deals, like, so it's like for your lifts, elevators, your swimming pool, pumps, and all this kind of stuff, I guess.
Not so much. So there are some rules around it. I mean, if you want, we could try and go through these. But I say, if somebody has a specific deal in mind, and what I can do is I can sort of point you in the direction. Maybe I can send you some links of to the HMRC guidance, where they talk about specifically what are considered to be fixtures and fittings, are eligible for capital allowances, and what are considered to be integral features. Because something like a complete replacement of a hot water system would be an integral feature, which wouldn't necessarily be allowable. But then again, things like fridge, freezer, washing machine, dishwasher, that sort of thing, potentially be eligible.
Okay, yeah, no, it'd be good to get the link to the place, and then we can share it in the group. Barbara is asking, as a British that owns a property in Spain and use it as a holiday let, can one deduct the expenses of it, even if it is on a Spanish mortgage, if the property is on a Spanish mortgage?
Yeah, this is actually a question quite close to my heart, because my husband's Spanish, so I've got a little bit of, even though I'm not in any way a Spanish tax expert, but it's something I've got some familiarity with. So basically, as owning property in Spain as a non-resident, then you'll be paying a straight 24% of the gross rents received. You're not allowed to deduct any kind of costs at all if you're a non-resident landlord living in the UK with property in Spain. However, in the UK, then you're allowed to deduct everything from from the income received from that Spanish property, as you would in the UK. So you'd be allowed to deduct your insurances, your agency fees, all this kind of stuff. And additionally, the tax that you pay in Spain will be eligible for foreign tax credit relief. So once you've worked out your taxable profits under the UK regime, not the Spanish regime, you declare that on your tax return. Any tax paid in Spain, you claim foreign tax credit relief under the double taxation agreement that we have between the UK and Spain.
Barbara is smiling. She's just made thousands of pounds. Just saved. Natasha, and then I don't know if we'll have time to go through all of them before the end of today. Let's see how much we can go through. So Natasha, getting the average, do all the properties have to be linked to the same company, or do you show they are all part of the same portfolio? So all of this is on the premises that they are owned, by you in your name. I'm guessing. Just tell me if yes or no, Penelope, and I'll go to the next question.
So exactly. So if they're owned in your name and you're operating the business, it's different if you've got a limited company that owns a property and then you own a property, because again, limited company is a separate legal person, therefore it's operating a separate business to yourself.
Mrs. Bihung is asking, are SA and HMOs taxed the same way? So no. So we're talking about short-term holiday lets, which is a HMRC name for what we call service accommodation. So none of this will apply to HMOs.
An HMO is just a normal residential letting.
Yeah. Mark's asking about the pensions. Can you contribute directly into your SAS pension from your profits? And are there any tax advantages doing this, i.e. decreasing your tax liability? Yeah, you've got a 40K allowance per year, I believe, that you can put from your business into your pension, whatever the scheme, and SAS is one of them. And I believe that there were some restrictions into the profits you could claim and put into that are lifted by some of the things Penelope talked about today.
Yeah, so exactly. So contributing, making payments into a personal pension scheme increases your bands and effectively gives you tax relief on that. So yeah, it's a beneficial thing to do.
Katrina is saying, thank you so much. That has been a superb session, and I tend to agree. Where would I find a surveyor to price the content separate from the buildings? I'm in the process of negotiating the purchase of a furnished 8-bed service accommodation. Do you know Penelope, or would you?
I don't have anybody that I specifically work with. If you're dealing with a surveyor generally, you probably want to start with just asking them. If you've got a property accountant, maybe they themselves might have somebody that they can recommend.
But is it something when let's say Katrina takes on your offer to speak with you? Is that something you can help? Depending on where they are.
I don't have anyone that I specifically refer to as a surveyor, but if if she gets in contact, then we see if we can find someone for her.
Yeah. Okay. Marcella is asking, the 85K income that implies VAT registration, is that net or gross? Yeah, that's your gross income.
Gross, yeah. So the other thing you've got to bear in mind as well is that if you use a booking platform, like Booking.com, Airbnb, that sort of thing, then the amount that they pay to you will be after deduction of their fees. So you need to look at the actual amount before deduction of their fees. It's the gross amount. It's basically the total that all of your guests have paid.
Okay. Amish is asking, just to clarify, with the limit of the 31 days, so is 31 days the limit you can run it as service accommodation for contractors? And is it the same if a company books regularly for 6 months the house and single group of contractors will be in and out? Then is this treated as a standard buy-to-let business in the eyes of HMRC?
Well, you need to make sure that you've got different people in there. That's the thing. So if you've got the same person in there for your 31 days, then that's going to cause you problems. I think it's one of those things is that the devil's going to be in the detail there. So, various options that you have for making sure that you continue to meet the criteria. The fact that you're renting it to one corporate body is not necessarily an issue. It's who's actually staying there. Are you renting, are they the public? And are they staying there on a short-term basis? So again, that's one of those things is that, you need to go through the detail and work out how you can make sure that you're meeting the criteria of being available to the public and nobody staying there for more than 31 days at a time.
Also,
for example, ways around that is, if they work Monday to Friday in London and then go home to Warrington on the weekends, they're not staying there. They're not staying there on the weekend. So then one could argue that potentially that you are meeting the criteria, but you'd need to make sure that you've got that kind of evidence. So HMRC, we have this concept of self-assessment in the UK. So you have to assess yourself according to the guidance that HMRC put out and according to the legislation that we have in place. But they are entitled at any point to ask you for evidence that you've applied the rules correctly. So you would need to have records showing how you've met that criteria. So whether that's asking, for records of who stayed there, I don't think there's any hard and fast answer there. You just need to make sure that you've got evidence ready should HMRC challenge you.
Awesome, thanks so much. I've got just a couple of questions. So Craig's asking, so actually lots of thank yous and thank you for the great session. So amongst the thank yous, Natalie is asking, does it matter if you have holiday let mortgage or as a residential mortgage, provided you have, I think your type of mortgage, does your type of mortgage matter in the eyes of HMRC?
It's called non-residential finance costs. So it doesn't even refer to mortgage in the legislation. It's just finance costs. So even if you've had a bridging loan or an overdraft or bank interest, it's just all finance costs. That said, you might want to check with your lender.
Yeah. So again, Natalie saying, can I convert my residential property into service accommodation? Yes.
Absolutely. It's not even something that you consciously do. You just to meet the criteria, you just look over the last 12 months and say, have you met the criteria or not? If you have met the criteria, you don't even need to say, you know, as of tomorrow I'm going to be starting this. If you've been doing it you know, without even realizing, you know, like Barbara renting out her property in Spain, you know, if you've been doing it but you didn't realize you were doing it, as long as you meet the criteria, you can still report on that basis.
And the last question for today, Penelope, thanks so much. So from Sam, is there any noise from it coming out of HMRC that they might stop these deductions on mortgage interest for those short-term holiday lets?
I've heard of. You know, there's lots of things. I mean, we've got an election next year. Who knows what a Labour government will bring? It's not been a particularly great parliament for you know, for landlords. I can see it getting worse, but there's certainly not been anything. You know, one of the things which everybody's been worried about is that they're going to take away entrepreneurs relief, you know, business asset disposal relief. But you know, I haven't heard anything. You know, talking about withdrawing the allowances for furnished holiday lettings. And personally, again, you know, just take this with a pinch of salt. I can't see why they would, because you'd be attacking a whole industry. And you know, particularly post Brexit, with everybody, you know, doing a lot more staycations. I know that that was something that was quite popular with government. So I can't imagine that they would be looking to close down this. It's not a loophole. It's just, you know, it's just a different way of renting your property.
Okay, I'm going to pop down I took a screenshot of your last slide. So if you want to take a note of Penelope's details again. I think it's well worthwhile speaking with her if you want to set up things correctly for your serviced accommodation and short-term rent business. Penelope, any closing sentiments or any word for the end?
It's been an absolute pleasure. You know, if anybody has any more questions and wants to get in touch, then by all means do so. I would say that it's, you know, ask your accountant, you know, these questions. If I've said anything here that you want to find out more about, you know, it's so much better to ask up front. And the other thing, you know, if you don't have an accountant or you're trying to keep your costs down as well, you know, look at the HMRC community forum. It's really useful because you've got a lot of people, you know, like yourselves, just asking questions and you know, getting responses most of the time.
All right, okay. Well, thanks so much. Thank you very much for joining us today on the Deals Final Corner. So do take on Penelope's offer for a free consultation call. Visit propertyfilter.co.uk, log on to your Property Filter account, check out the deal blueprint where you can define your goldmine area, engage with motivated sellers, assess properties in seconds, and load your pipeline and make deals. Have an endless supply of deals, join the top 1% and become a high achiever deal finder. I hope you enjoyed today's Deal Finder Corner, and I look forward to seeing you next week. Thank you very much. Bye-bye.